In relation to Ally Financial, in relation to PayPal, customer during a coaching session had asked about, can the stock repair tool be used for a long call? And the answer is kind of yes and no. Yes, it can. Now, we recently referenced a couple of webinars that we did back in April. We had one on 8 ways to manage a profitable long call. And we also had one the week before that on ideas on managing a losing long call, converting it to a credit or debit spread, converting it to a diagonal spread, or maybe creating a butterfly around it. Well, first, what is the stock repair tool? Let's take Ally. And again, let's take a look at the chart first. Remember, it was right around 56, 55, 50 right before earnings. It had a good run up right before earnings, and then investors weren't happy with the purchase they made, and maybe with other things. They did beat estimates, of course, and they did beat revenue, but it's now down to 50-50. So let's say I was a just bad person, and no, I'm just kidding. Let's say I did something bad that Mike normally wouldn't do, and I just bought 100 shares at 55.70, let's say, right before earnings. Okay, rather than buying a call, rather than speculating with a call, I bought shares, 100 shares outright at 55.70, and now the stock's at 50-50. Is it possible that this could be repaired with a stock repair position? Let's just go ahead and put in 55.70, and let's put in 100 shares. And we're down about, as we saw, 9.5, 10%. Okay, there's no credit repairs for this position. I do see debit repairs. Now, what is the stock repair? What it's attempting to do is find sort of a ratio call spread that can help you get back to break even faster. Cost basis of 55.70. It shows me here that we could do a spread by buying a 50, buying a 55 out to January, 90 so odd days away, and my break even drops down to 53.28. Well, how does that happen? Hopefully we could find a credit repair. In this case, we couldn't. What this is showing us is we could buy one January 50 call at 335 and sell 2 January 55 calls for $1.25. So we're going to get 250 in. It's going to cost us a debit of $85 or 85 cents on the 100 shares. I'm selling 2 and buying 1. It's a ratio call spread, but nothing is naked. Okay? One of these calls is covered by the 100 shares that I own, and the other short call is just a bull call debit spread, buying a call at 50 and selling one at 55. Everything is covered. There's no naked position there. Your broker would see it as a covered call with a bull call debit spread. You might need still level 2 trading to do this, to do the bull call debit. Now, why is the break even at 53.28? My cost basis is 55.70. If the stock's at 53.28, I'm still down 242 on the stock, and I paid an 85-cent debit. So that's about 329, 327. What do I also have? I have a January 50 call that I only paid 85 cents for that now has a value, an intrinsic value at 328 at January expiration. I'm now at break even with a total value of 55.71 without needing the stock to go back to 55.70. It helps me get back to break even faster. It is 90 days out. And if we go to the profit and loss chart for this position, it's a maximum 6.1% return in the best case scenario. Zoom in here a little bit. If the stock is trading above 55, I deliver my shares of stock at 55. I get the full 5-point benefit back from the bull call debit spread. And the stock's trading, we had a cost basis of 56.55. So I get 55 back by the assignment on the covered call, 100 shares assigned on one call, and we get the 5 points back from the bull call debit spread. So that gives us our profit there of 345 total. As my total cost was 56.55, we get about 60 back at the stock's 55, but the break even is only at 53.28 because of that extra long call that if I'm right and the stock moves back up, it accelerates the gain on the swings. Now, what if I didn't buy 100 shares of stock at 55.70 right before the earnings? What if I bought a 55 call for $2? January 55 call at that time for $2. What would that look like? Would this repair still work? Well, yes and no. Let's take a look. January. Bought a 55 call at that time, probably for more like 250. Oops, I added it in twice. So yeah, let's say it's more along the lines of $2.50 or $2.80 that I purchased this long call right before the earnings when the stock was trading at 55. Does the repair still work? Well, this one's tricky. The answer is yes, but it creates more of a bull call debit spread where my break even is down now to 53.65. Unfortunately, this couldn't be done. Why? Because my broker would see it as if I had bought a January 55 call and the repair is to sell two January 55 calls, this would be simply closing that original call for 125 and then entering a bull call debit spread. So I'd have lost $1.60 in this case. Right? You can't be long and short the same option in the same portfolio. I can't be long the January 55 call and sell a January 55 call, then sell another one in a bull call debit spread. This would have just meant I closed my initial one, my 55 call, for about $1.25. So that's going to be a loss of about $1.55. So let's add that loss in. This would be $4.90 cost basis for the one call left, which would create a bull call debit spread in that case. Oh, I'm sorry. I had to clear this out. My apologies. Yeah, we're going to clear that out. It's just going to be the one bull call debit spread with the increased cost. I'm sorry. But the break even still 53.65. Remember, I had originally bought a 55 call for 270 roughly, which would have put my cost basis, my break even, at 57.70. In this case, that's not it. It still would have worked roughly in that case. Now, had I bought a different strike call for January, had I bought the 50 at the time, let's see what we've got here. Yeah, if I had bought the 50 when the stock was trading at 55, so it probably would have cost me $6, maybe higher, $6.50, I think I originally looked at in this case, but anyway. Oh, $6.28, I'm sorry. So that day when the stock was trading at around 55.70 or so, the 50 call was at $6.28 on the position. Is this repair going to work for me? Well, no. Remember, this would have... oh, let's go back. I'm sorry. Let's go back to the actual repair. It was buy another 50 and sell two 55s. Sorry about that. And I had a 50 call. Now, this I can do, but again, as we saw before, what is this going to do? It's just going to create two bull call debit spreads with a break even at 53.48, not at 56.28, which is the original break even at January expiration for the long call. But this sort of created two debit spreads, didn't it? I have a 50 call bought at 6.28, the same 50 call bought at half the price, now that's declined at 327.50, and I sold two. Another way to kind of look at this is we created two bull call debit spreads, but depending on where your call is, it was one of the entries we had in that discussion in that April presentation for managing the long call. Essentially, I'm turning this into a butterfly. It just so happens with my strikes, it looks like two bull call debit spreads, but I sold two calls at a higher strike and bought another call. This would have created sort of a butterfly. I'm adding a ratio spread on top of a long call. That was sort of discussed. It's sort of a stock repair, just depending on which strikes you use. A different example that's a little bit easier to see that in would be PayPal. Now, we saw PayPal have significant declines recently in that case. Let's take a look here. And so PayPal now, it's been on a down run almost the same as Ally, but for 3 days in a row. Same situation. Let's say I bought stock at around 270 over here somewhere, maybe even 265, and now it's down to 240. Would the stock repair work in this scenario? Well, let's take a look. Let's give it PayPal. Let's take the middle range. We'll just say a cost basis of 268, close to 270, a little bit above 265, and we bought 100 shares. See, now there's credit repairs available, but still not out to January. I think when I used a cost basis of 265, a November repair appeared. But that's okay. Let's take a look. The repair details again, what am I doing in this case? We're going to be able to buy a January 240 call for $16.35, and we're going to sell a January 260 call, two January 260 calls against our 100 shares for $8.20. Okay, it's a credit of 5 cents, but this lowers my break even down to $253.98 from $268, and the stock's at around $240. Again, how does that work? Because if the stock's at $253, I do have a $14 loss on the position, but at expiration, that $250 call that we received at a slight credit of 5 cents is worth $13.98. So now I'm back to a profit of $268. I've only lost $14 on the stock that's made up by the value of the long call without the stock needing to go back up to $268. I only needed to go up to $254. Let's just call it $254. And if it goes higher, I might see a profit in this case of $12.05 if it goes back above the 260 calls, again, the max return. Well, let's look at that graph. Oh, I'm sorry, for that January repair. Let's open that up full screen. Okay, so we're buying one at $16.35, selling two at $8.20, and that generates the small credit, puts my break even at right at about $254 at January expiration instead of $268. And if it does go up to $260, even with my cost basis of $268, we've got a profit of $12.05 or 4.5% instead of a loss. Gets us back to break even faster. But let's say I didn't buy the stock at $268. Let's say in this case I had bought a $270 call. I think I was looking at, maybe it wasn't. No, it wasn't that. I'm sorry. Let's say instead of that time, instead of buying the stock at $268, we bought a January 260 call. We're actually going to use the 255 call at a different price. So let's say I bought the January 240, 250, 260. Okay, so let's say that we had bought the 240 call. No, I don't want to do that. Yeah, I'm sorry. I apologize. Let's say we bought the 250 call for $18. So that the cost-based stock price was around $268. So in this case, I buy one 250 call at $18, which again, if I exercise the 250 call when it had been in the money, and keep in mind the 250 call is now much lower, it's only at $11.50, it's a losing call. I'm losing $7 on the 18, so it's a pretty significant drop. This sort of creates two bull call debit spreads, doesn't it? One with the 260, 250, one with the 240 and 260 that came up in the repair. But again, the break even around the cost basis of 268. Why 268? Well, if I had bought the 250 call for $18 instead of buying the stock around 270 or so, then the repair might still work in that position. But again, you're adding a ratio spread on top of an existing long call, which sort of does, depending on the strikes, create a butterfly. If I had bought the 270 call for $5 at the time when the stock was up to, okay, so it would have been more, but let's say we bought the 270 call at the peak there, when the position was probably around $10 or so. Would a repair work? Well, potentially, but what I would have had to done is check on the stock repair to see if there was a repair available if the cost basis was 280. Why 280? The price of my call plus the price I paid for it. If I exercised the call, that would be my cost per share. This would now look sort of like that butterfly position. Does it help me get back to break even? Well, I can get a break even at 249 in this case and in this range, and at 260 I'm looking at a good profit, and I have a good profit if it continues up here. The problem is if it continues to move down, because we're already down here at the loss, I'm looking at a max loss of $9.95. Didn't get too much because we only got the 5 cent net credit. So in this case, even if the stock stays where it is to January expiration, instead of losing $10 on the 270, we're going to be losing $9.95. But if it does come back up, my break even is down to $249.95. Let's just call it $250. I'm sorry. In that case, I didn't need it to go all the way back up to 280, which would be the break even of just the original call. So it does work, but what does it create? It kind of creates a butterfly, which is a way. If my call is deep out of the money now, and I create this butterfly, it does help me get there, but I can still take a loss on the position if the stock continues down equal to what I originally paid. But if it does move up, I only need it to go back up to 250 to break even in 90 days at January expiration. And I might see a profit if it's at 260, where at 270, I'd still be a loss. So I did create a butterfly, but this was using the stock repair tool with the price of the call plus the premium I paid. So if there is a repair for PayPal, if my cost basis was 280, then there would be a repair as well if I had a 270 call that I had paid $10 for. That's what I would put in, the strike price of my call plus the premium I paid. See if that's available in the stock repair, then analyze the trade to look at the profit and loss chart, and then substitute your call for the stock with your price that you paid. That might be a helpful way to get back to break even. But as I mentioned, again, of course, let's just close this down here and go back to our main windows. That view was sort of discussed in that webinar on our YouTube channel for Long Call. And this was back in April. So let's just look. There we go. Adjusting a losing long call. Well, this is one of the first ones that came up 6 months ago from April. As I mentioned, it discusses that butterfly approach in there, which is essentially adding the stock repair onto the long call. If it's now deep out of the money, can help you get back to break even. Depending on the strikes, it might look like 2 bull call debit spreads, but it might be able to help you get back to break even. But remember, if it's a debit repair, you are adding more cost in the position, and if it continues down, you could have a larger loss than on your current long call, and the profit loss would show you that.